Alright, welcome back. This is a continuation video of the SPVC Type 1. So if you haven't watched the Type 1 video, please go back and do so right now before continuing watching this video. I want to make this clear to you. I try as much as I can to make the video very short. So every concept I explain on this channel is fully explained in detail in my mentorship program. That being said, grab a notebook and a pen. Let's discuss what we have for today. Alright, back to the chart. So looking at the type 2 SPVC type 2, the swing point volume candle. Alright, the type 2 can be used for continuation and as well as reversal. Okay, I will explain that as we progress in this video. Now, this is the structure of the type 2 schematic. We have a big candle, a big bullish candle. All right, so this should have been an uptrend, right? Should have been an uptrend to have this big candle. So a reversal, this is a reversal. Okay, now we have this big candle. For a bullish candle here at this level will be the open, low, high, close. All right, for bearish this will be open, high, low, close. All right, so that being said, now what do? We mark the high and the low of the big candle covering the small candle. All right, so after marking out the level, so this place can be referred to as a ranging market. All right, so when you zoom this is a daily chart. All right, so when you take this to a smaller time frame, the H1, the M15, you observe that this is a ranging market. All right, so but we don't go back there, we stick to the daily time frame. So what happened? We are expecting a close above this level or below this level. Let me repeat myself. We are expecting, we want to see these two candles. This is a type 2 schematic. Note that. So what we are expecting a close above this high or below this low. Do you understand? So in other words, you can have multiple candles. You can see a range. The market can be ranging. See other candles ranging in between and all of that. But once we see a candle closing above or below, that is what brings our interest to the market. Right? Very good. So once, as you can see from this example, the price came here and closed below this level, so it means there is a reversal, right? Market is bearish, it's going back, it's going downward. So what do? Well, we have to wait for a pullback. There must be a pullback candle. So you don't just come here and say there is a close, you just enter for a sell. Do you understand? You don't just enter like that. You have to wait for a pullback. All right, so there will definitely be a pullback candle. So that is where we employ our Fibonacci. If you have not watched the Fibonacci video, the secrets of using Fibonacci, check in around this video or check through my videos. You see how I explained how Fibonacci is used to optimize your trade decisions. All right, so you grab your Fibonacci retracement, then you do swing low, swing high, because it's now downtrend. You understand? So you wait for a pullback, then you execute your trade at your best entry, then allow the market to do what? Sorry about that. So allow the market to go down. You have your TP1 and TP2, the extension zone. All right, so let's look at a live example from the chart. I always follow the trend. You don't do anything against the trend. The trend is your friend. All right. So one of the things that should bring your attention, to the market is the trend. Is this market trending or is ranging? Just note when the market is trending. So from what we have here, this is a trending market. All right, especially daily time frame. And of course, one of the giveaway, I don't know if I should say this here. Those in my mentorship program, please permit me to say this here. All right. For type 1 schemas, for the type 1 schematic, SPVC type 1, type 2, type 3, type 4, you should concentrate on a higher time frame. Do you understand? If you want to execute a trade, of course, you go to a lower time frame. You understand? The entry model will explain all of that. But basically, in looking at your structure, okay, in considering the SPVC, ensure you use a higher time frame. You can go to your weekly, your daily, and H4. All right, and look for your SPVC type 1, type 2, type 3, and then type 4. All right, so let's look at what we have here. This is a downtrend. Okay, let me zoom it up a bit so it could be bigger for us to see. So as you can see, the price, you can see the price movement. Like we have seen, this is a downtrend. A lot of lower lows and lower highs, lower low, lower high, and all of that. So as the market is coming down, we can, remember I told you that the SPVC type 2 is used for continuation and reversal. So this is the continuation. So you can see this big bearish candle, right? You can see a doji, a small candle inside. So that's why I marked this range. Look at the range, the high and the low. So the next candle could not break the range bound. The third candle broke it and closed at the same level. It was this candle, that closed outside this range. So which means the direction of the market is down. So since we have seen a close below, it means we're expecting the price to continue downwards. So at this point, what do we do? All right. Now, we'll go back to our Fibonacci retracement. Observe the candle that closed below the range. From that candle, this is the candle. We'll take swing low, swing high. Don't mind my drawing. All right. The high and the low of the candle. You can zoom it up a bit. This is the high, and then this is the low of the candle. Very good. All right. So as you can see, this is the high, This is the low. So it's in a range. So you can see the candle outside this range. So what happened? We'll take it, we'll swing here, low, swing high. Alright? So what happened? Remember I told you must wait for a pullback. So the price started going back up, right? Hitting our what? Good entry, which is this, and continued to our what? Best entry. So you do your refinement using our entry model. You go to a smaller time frame, H1, M15, execute your trade for a sale. Then you project your TP1, TP2, and your TP3, which is the extension. So what happened? The market got to extension and started going back up. Have you seen it? Extension is an area where the market is likely to reverse. Okay, that being said, let me take this out. So you can now see the market ranged here. Remember, we've taken our profit, right? The market ranged here and took out here, started coming down, and it came back inside this box again, inside this range. So since I know that it's a ranging market, of course, look at another structure here. If you are very observant, you will see this. This is it again. Sorry, permit my drawing. Let me remove that. Let me take this one. Sorry. Okay, very good. As you can see, this is another range. This is another range. Good. So you can see here and here. Look at the candle inside. Broke above. Right? So, but the reason why you will not take this trade is because the market is on a downtrend. So, for example, if you say, this is another structure, let me buy. Market closed above, came back inside the range. If you click buy, you will lose money. Why? Because you are working against the trend. So everything you are doing should be in line with the dominant trend of the markets. That is how you win. All right? Okay. So let's continue. We have another example. Remember, downtrend, continuation, right? So you can see a lot of lower low, lower high. So the market came here at this point, this swing point. We have this level. Okay, and this price could not break above and could not break below, so it's bound on a range. So what do? We wait for a candle to close above or below. So we're anticipating sell, bearish, since the dominant trend is bearish. So we are expecting a break to the downside. So you can see a big bearish candle closing below the range. So you don't just come here and click sell. No, you wait for a pullback. So as you're waiting for the pullback, you can quickly grab your Fibonacci tool. Again, go and watch that Fibonacci video. Swing low, swing high. Alright? Swing low, swing high. Now, what happened? The market started going up. Look at the reaction on our good entry. Have you seen it? This is a good entry. But remember, you must wait for a sweep of the good entry. Most times the market will sweep the good entry, go into our best entry. You can see the market, boom, it's our best entry. If you refine this to a smaller time frame, H1 M15, you see our entry model here. You execute your trade, your stop loss will be here, you continue the trend. This will be your TP1 smashed easily, right? TP2 smashed, TP3, which is your extension. Now watch the trend continue. So after taking your profit, you wait and observe. Now what happened? The market came here. Remember, this is a lower low, lower high, a new lower low, lower high, lower low. All right. What happened? The market started going up. So expecting a lower high, then a new lower low, right? But what happened? The market came here, took out this level. Have you seen it? This level was taken out. You zoom it very well, you'll see. This level was taken out. This is break of market structure, right? Taking out and another take out up. The higher time frame. So there is a break of market structure. So now observe our type 1 schematic. Look at this big bullish candle. Look at the small candle inside, right? And the break. This is a close above the range. This is the range, right? This is the range box. Break of structure, close above, right? And then it's coming back inside to retest. So what do? Rule implies we grab our Fibonacci 2, swing high, swing low. Okay, have you seen it? Boom! Look at here, good entry. It came to our best entry. Stop loss. TP1 smashed. TP2 smashed. All right. Okay. Another example, which means the trend has changed. You understand? So the demand is now greater than the supply. All right. So we are bullish right now. So we now see a higher high, a higher low. Let me remove this so that the chart will be clean. A higher high, a higher low, a new higher high, then a higher low. So as the market is coming down, right? Remember, we are now on a bullish market. Okay, so the market is coming down between this level and this level. You understand? Higher high, higher low, higher high, higher low. Look at our type 2 schematic here. Once you see this, grab your Fibonacci. Swing high, swing low. All right? Very simple. Don't complicate it. Good price. Look at the rejection candle here. Smashed down to best price. You refine, go to smaller time frame using our entry model. Execute for a buy. Boom. TP1 smashed. TP2 smashed. If you're combining it with divergence, as you can see, look at this level. Look at this level. Have you seen it? Very good. This low is higher than this low, but our indicator is printing opposite. Sorry about that. Very good. So as you can see, it's the opposite. Look at it here and here. Here, opposite, divergent. So that's another confluence. So we have seen trend, so number one confluence, divergent, number two, Fibonacci, number three, right? Best entry. Then we'll see our SPVC type 2, 4. So this level, if you look back, you observe that this is a key level. This is a key level. 5. So the market, boom, up. Alright, if you gain value in this video, ensure you subscribe to this channel, like, send us your feedback on the comment section below. Okay, and wait for the type 3 schematic. The video will be dropping soon. Alright, thank you very much. Bye.